Hello guys, hello ACCA students. How are you? Good. I hope you are doing well. My name is Jerome Tumkulu, and in this presentation, I'm going to take you through the financial management function and working capital management. I'm not going to cover the whole spectrum of this topic, but I'll I'll try as much as possible to ensure that we have covered much ground. All right. So expect a series of videos on this particular topic. All right. There could be a series or maybe 2 or 3 videos related to this particular topic. Right. They might be lengthy. Please forgive me for that. Or they will be shortened for your quick grasp and convenience. All right. I hope you guys are going to write or to sit for an upcoming financial management examination from the ACCA in the coming month. So please pay good attention or careful attention to this presentation. If you find the video useful, please do not forget to subscribe, share, and comment so that we continue to produce more such videos. All right, without much ado, let us get straight to the business of the day. Okay, what is the nature and purpose of financial management? Financial management can be defined as the management of the finances of an organization in order to achieve the financial objectives of the organization. The usual assumption in financial management for the private sector is that the objective of the company should be to maximize shareholders' wealth. The reason why we put a qualification in the private sector is that it is not always the imperative of financial management to maximize shareholder wealth. Sometimes the finance manager's focus would be to ensure that the shareholders' um, objectives, which might not necessarily be linked to wealth maximization, are achieved. For example, uh, investors in a charity or a charitable organization do not expect to maximize their wealth, but they might be having an objective of ensuring that a pandemic or a health hazard has been mitigated or the world has become a better place. So, in that situation, the objective of the finance manager should be to ensure that the society's well-being has improved, right? Because the investors would have invested their money with the hope that the society is going to be improved in the shorter, medium, or longer time. All right. Then, financial management decisions cover 4 main aspects. However, the first 3 are key: investment decisions, financing decisions, dividend decisions, and lastly, risk management. So, when you enter into the examination, you should have these 4 decisions in mind, whether the type of organization is a charity or is a governmental organization or a profit-making organization. When you enter into the exam hall, you need to ensure that you are mastering, or you have got a better or solid understanding of these key decision areas: investment decisions, financing decisions, dividend decisions, and risk management. All right, we'll cover more or in detail in the coming lectures. So for now, just have this brief understanding. What are the key or the 3 key fundamental areas the finance manager has to be in or has to understand? We have spoken about those ones, and I have listed them as investment. Okay, there is investment decision, there is financing, and then dividend. Those are the key areas. All right. However, you need to remember the fourth one. The fourth one, if you still remember, risk management. All right, the RM. However, in taking financial decisions, the financial manager will need to take account of the organization's commercial and financial objectives. All right, so the manager has to understand these objectives. What are the entity's commercial objectives and what are its financial objectives? When we talk of commercial, we are looking at business wide, the reason why the business was formed, right? Because when a finance manager looks at a firm's balance sheet, or a finance professional, when they look at a firm's balance sheet, they expect their revenue, or let me just say income. They should expect this income to be generated from ordinary activities. The ordinary activities are those activities, under which the firm's reason exists, or maybe those activities which speak or which pronounce the reason why the firm exists. For example, if we are looking at a manufacturing firm, we expect its revenue to be generated from its ordinary activities. We do not expect much of their revenue to be generated from the selling of non-current assets. Why? Because we are not there to sell our office tables or our old motor vehicles. So those motor vehicles which have been sold either because they are now obsolete and so forth, their revenue should not dominate the main revenue. All right. Why? Because the entity is not there to sell its office furniture or office buildings. No, it is there to manufacture goods and services which should be sold to the outside world. So you need to ask yourself, what are the business objectives of this entity? Then, when it comes to financial objectives now, we are saying, what is maybe the risk appetite of the business? What is their investment attitude? What is their dividend attitude? When we talk of dividend attitude, we are referring to the situation where are they always expecting a dividend year after year? And when they expect this dividend, do they want it in the, as an increased dividend or as a constant dividend? So those are the financial objectives. Then, when we look at the risk, we are simply saying, how risk averse are they? All right. Do they believe in modern hedging techniques, or they just want to remain conservative? All those things the finance manager should ask himself in undertaking his duties. Now, the second area the finance manager should look at is the broader economic environment in which the business operates. Are we operating in a hyperinflationary environment? Are we operating in a highly regulated environment? All those things the finance manager should be aware of in making finance decisions. Lastly, the potential risks associated with the decision and the methods of managing that risk. Are we going to use hedging techniques? Okay, the hedging. Are we going to use the TARA framework, right? Where the risks are transferred, sometimes are accepted, sometimes are avoided, all those things or reduced. So that's the TARA framework we are talking about. But we'll be looking at these topics in the future. Like I said, this is just an introductory topic. Let's look at strategy. We have already mentioned that the finance manager should be aware of the firm's commercial and financial objectives. However, on top of objective, there is a strategy, because um, we might be having objectives, but we also need a strategy that will actually map a way for us to implement or to achieve those uh, objectives. So, strategy is a course of action to achieve an objective. There are three main levels of strategy in an organization. There is the corporate strategy, which is the general direction of the whole organization, right? This one is usually set at the top level, right? Or maybe the apex, or by senior management or the board. Then there is the business level strategy. This one is how the organization or its business units tackle particular markets. Lastly, the operational or functional. This one is more precise, is more specific, right? Where specific strategies for different departments of the organizations are tabled. All right? So that's more of strategy. What are corporate objectives? Corporate objectives are those which are contained with the firm as a whole. Objectives should be explicit, quantifiable, and capable of being achieved. Remember the SMART framework or SMART acronym, right? You need to bear in mind and understand this SMART. All right, what does SMART stands for? Okay, if you still remember, SMART stands for, the first S stands for specific. You need to actually see what you intend to do in mind. Need to, it should be clear, right? The objective should be clear. It should be measurable. All right, you cannot achieve what you cannot measure. That's the rule, right? You need it should be quantifiable. The objective should be quantifiable. All right. Then we have got the A. A stands for attainable, attainable or achievable, achievable. R simply means realistic, realistic. Could an average professional achieve the same result? Can they achieve the same result given the circumstances? Is it possible to achieve that target? Otherwise, if you set a target which is too high, it will demoralize the employees. They're not going to work because they see it as something outside of this world. Then lastly, timeliness or time bound. Timely or time bound, something like that. The objective should be timely, okay, time relevant. All right, or within a set, it should be achieved within a certain time. Okay, there should be an aspect of time to be considered. The corporate objectives outline the expectations of the firm and the strategic planning process. Okay, and the strategic planning process is contained with the means of achieving the objectives. All right. Okay, continuing with the corporate objectives. Objectives should relate to the key factors for business success, which are typically as follows: profitability. Okay, what is the return on investment? Market share. What's our market share? Growth. Right? Are we intending to grow or we are reducing operations? What are the cash flows involved? Customer satisfaction. How do we intend to satisfy our customers? All right. something like that.